Indonesia's plan to cut oil imports from Singapore amid U.S. tariff talks may pressure trade flows, but experts say the impact will be limited. They suggest that diversification of the economy into areas like technology and manufacturing will continue to prop up growth. Still, they caution that spare capacities may have secondary effects on transport and storage services and wholesale trade sectors. Nadirah Zaidi has more.
In the first 4 months of 2025, Singapore exported more than 54,000 barrels of gas oil and 8,300 barrels of jet fuel per day to Indonesia. Its Energy Minister, Bahlil Lahadalia, says about 60% of Indonesia's fuel imports come from Singapore, but that may soon change. Jakarta is looking to ramp up fuel imports from the US as part of a wider proposal to address tariffs. Despite this development, experts say the impact on Singapore's economy is limited.
Even if Indonesia were to scale back their imports, Singapore is resourceful. They've got an infrastructure, refineries, storage terminals, support services. And besides that, they are the major pricing point east of Suez. You've got all of the major technology companies setting up offices out here, the Facebook, Google, Amazon. Singapore is not as dependent on oil, and I think that's been a deliberate strategy on their part. They want to diversify away from a reliance on oil.
The oil industry contributes about 5% to overall GDP, smaller compared to other sectors like manufacturing, which makes up about a fifth of the economy. Still, one analyst warns that if other countries follow Indonesia's lead, the impact could be multiplied.
There could be second-round effects on the transport and storage services sectors. Also, the wholesale and retail trade sectors could also be affected because the activity drops. That could also limit the port activities. Then, that may also affect second-round effects, right? When you have less demand, the manufacturing sector, the services sectors may also be impacted.
Other potential short-term challenges include excess oil supply that could push prices down. Even then, analysts say the market is likely to stabilize over time.
Singapore most likely will be stuck with little more oil because there is no buyer of it. That should put downward pressure on Singapore oil that they are selling to, say, Malaysia and other countries, so profitability will go down for the refining business for Singapore. But in the medium term, Singapore will find other buyers who could be suitable buyers for Singapore's refined oil, and things will be fine.
Potential players in Singapore's market could include countries from the Middle East. There may also be interest from investors like hedge funds and banks.